Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to help you, to give you guidance, help you if you need advice. There's the disclaimer.
All right.
And let me share my screen. As a quick note, anyone joining us for the first time, Will and I, we do this show in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. If you'd like to come on a show and ask your question live, we also provide a link to Zoom on that live chat. Click on the link. Once you get into Zoom, log in. There's a button, raise your hand at the bottom of the screen. Click on that. That alerts us that you have a question. Once we let you in, you could come in, ask your question live and direct. So to give a couple minutes for you guys to type in your questions or for more people to join us, we'll start out taking a look at the pre-market report, see if we could get some insights on what's trading in pre-market hours, and then we'll move on to the questions. So let's start with the pre-market report. These are stocks trading in pre-market hours today. I'm going to scroll down here and I see we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 25 stocks made our percentage gainers list, 69 on our decliners list. So right now, from this perspective, looks like the trading in the pre-market hours has some bearish bias. Let's take a look at it from another angle. And I'm going to come up here. We have a calendar view. And this, you could go back days to get a summary of what happened in the pre-market hours. Today, September 25th, we see 212 stocks are trading higher in the pre-market hours versus 420 trading lower. As far as number of shares, we have 96.4 million shares trading on up volume versus 76.2 million shares trading on down volume. And if we convert those shares to dollar value, since not every share is the same price, there's $416 million worth of stock trading higher versus 2.6 billion stocks trading lower. So from that perspective, also looks like so far in the pre-market hours, we've got some bearish sentiment. Let's do one more check and then we'll move on to the questions. And I'm going to come back down here to the pre-market report. And in this report, we see there are small cap stocks, ETFs, leverage products, any security that's listed on a major US exchange. If it's trading in the pre-market hours and meets our thresholds for liquidity, price, volume, it could make this list. And to narrow down this list to a small group of stocks, we could use the filters above. And if you do have a watch list, you could filter by your watch list. I'm going to use this one in ETF. For this example, I'm going to click it down. You get a list of ETFs to choose from. Let's select this first one, SPY. That's the S&P 500 ETF. And when you click on it, the list below gets filtered by stocks that are holdings in that ETF. So in SPY, it's the S&P 500 constituents. And here we see 4 stocks made our percentage gainers list, 8 on the decliners. So not a really big list, but also kind of indicating more bearish bias in the pre-market hours. So, well, we gave it a couple minutes. If you have any questions that came through, I'll take the questions.
Nothing's popped up, D.
Okay, so let's take a look at SPY. And I just default to it. We don't have any questions. And I think one of the questions, that pops up. Well, let's do this first. I'm going to go to the fundamental ratios here. And one of the questions could be, where the present state of the market, is it high? Is it low? Is it fair value? And when we try to answer it, we have to answer it based on relative to what? How are we trying to answer that question? High based on what assumptions, based on, what metrics we want to use, right? So I'm going to walk you guys through this. I think this is not yet published, actually. I'm still working on it. I've shown this before, but we'll do this again just to get some insights. And we're looking at SPY, S&P 500. And to value it, we want to see, okay, if we bought all these companies in the S&P 500, we just bought them outright for cash, right? And we paid off the debt. So if we took that and we said, okay, now we own all these companies, we paid off all the debt, we know how much that would cost us, right? Because we know the market cap of the stocks, we know how much debt they have. So we could calculate their enterprise value. And then we'll say, now that we own all of them, we're entitled to the earnings, right? So now we have the earnings for all these companies. And how much are we yielding on that amount that we just invested, right? That's the enterprise value. The enterprise value is if we bought everything for cash outright, how much are we yielding on our cash? So think of it as if you bought a piece of real estate property, for cash, no mortgage, you bought it outright, 100,000, then you said, okay, I'm getting this rent, how much am I yielding after my expenses, right? How much am I returning per year? So that's what we're looking at. It's the operating yield right here. So here in the beginning, we see that if we just use this year's trailing 12 months over the enterprise value, we're yielding 5.3%. Right. So that's the return on your enterprise value or on cash. And then we have to assume, okay, well, if we yield that, we're investing because we think earnings are going to grow. Just like if you bought a property, you think, well, rents are going to increase, so earnings are going to grow. And we have to make a guess on how much it's going to grow because there's no way of knowing for sure if they're going to grow 10%, 5%, or go down. So this becomes a guess, and there are lots of analysts trying to guess earnings growth for each company, right? And that's always changing. So if you follow any analyst, or you could look at Goldman, Bank of America, even the Federal Reserve, they all try to predict future economic growth, right? And since we don't know for sure, what the earnings will grow by, we could do a starting point and let's look at the long-term trend. So, if we smoothed it out over the long term, and this is 5-year, you could see that even 5-year growth rates, because if you look quarter to quarter, it's all over the place, even year to year. So if we smoothed it out over 5 years, this is a 5-year moving chart, you could see it's all over the place and had this huge bump up here. It's coming down now, and a lot of that's due to the stimulus. So if we took that, I'm hovering over there, that green line, see that green line all the way, that smooths out the long-term 5-year growth rate right now at 6.6%. Okay. Median 5.4%. So let's just put the 6.6%, as our best guess right now. So if we do that, right, if we start out at 5.3%, if earnings grow at 6.6% per year, right, year over year for the next 5 years, what would that average out to our return over the next 5 years? So that comes out to 6.4% per year. Okay, so think of it this way. If I start out with $5 and it grows by 6%, next year will be $5.30, then another 6% over that'll be $5.60 something cents. So on average, year over year, I think this will yield 6.4% in the next 5 years. Okay, so then we got to decide, well, is that a is that a good yield or not? Right, is that worth it? Because if that's a low yield, if that's too low, that means that either I'm wrong in my estimates, or if these estimates are right, then I'm wrong in the price we're paying, the market cap, right? Because then I should be paying less, and that's how the yield goes up, right? So think of it, if your rent is $10,000 a year, right? $10,000 a year. If you pay $100,000 for the place, then you're yielding 10%. But if you pay $200,000 for the property and you still make $10,000, now you're only yielding 5%. So if the earnings or the rent stays the same, then it's how much you pay for that cash flow, right? How much are you paying for that forward cash flow makes a difference. So are we paying too high for this? If we assume that these are good estimates, right, for now, then we have to compare this to the risk-free rate, right? Because why would I take a risk if I could buy the 5-year treasury at 4.5% right now yielding? If I could make the same thing in the treasury, there's no point taking risk, right? Then you should stay at the risk-free rate. So we see it is paying a little bit over. It's paying 1.87% over. That's your yield premium, your equity yield premium, right? So this is how much it's paying over, assuming these are correct. So what if we change this and say, well, 1.87% is not that enough, right? And this is a little bit subjective. In general, what is the correct answer? I don't know. We could look at the 5-year average, here's the averages. We could look at the difference between, let's say, the risk-free rate in mortgages, or the high yield bonds and the AAA bonds, or whatever. We could start making some assumptions. What should it be? Sometimes it's going to be subjective what you think it should be, but in general, I start out at 3% because that's what I see usually the difference between riskier assets and non-riskier is about a 3% premium, right? That's what you want to earn on average, 3% more than you would on a risk-free rate to take on that risk. Otherwise, it becomes, it's a little bit risky. So if we added that, you see, I just changed it to 3%. Well, what this is saying is for us to earn 3% above the treasury, 3% above this 4.57% year over year, right? And we assume these are correct, right? That means we would be paying $269 for SPY. So you could see how just a little bit, right? We started at 1.87 around, and then if we just go to 3%, you could see how sensitive the prices could be to, the demand in yield and interest rates. But let's stay at 1 point. Let's stay at 3 and say, well, maybe what we're doing wrong is earnings growth. Maybe this earnings growth of 6.63% is too low. Maybe we do have like ChatGPT, AI. This technology is really going to propel productivity, and earnings are going to grow at an accelerated rate. Well, we don't know what that rate will be, until it happens. We could just put in a guess. And what this could help us is saying, well, if the market is right at 430 and we need and we require a 3% yield premium, what should this earnings growth be? So then we could just start, changing this. Let's say if it's 10% year over year. So you see, we're still 364. Is it 15% year over year? 520, that's too high. 12%. So you could see it's around 12. So is the market implying, that's what we're trying to do, is what is the market implying? So the market at this rate, if we assume that we need a 3% risk premium yield, we know what the 5-year treasury is paying, right? We could lock that in for 5 years. So to make 3% above the risk-free rate for next 5 years, year over year, the market implies that we're going to have a 12.5% growth rate in earnings year over year, right? Which maybe, we've seen it here. That's probably on the top end here, 11.9. I'd have to go back maybe where we had so it's a stretch. It's possible, that is possible, but we're trying to get a sense of what the market might be implying. That's the point of this is, what is the market implying? Like, what is the market implying that earnings may grow by? What is the market implying how much risk premium there is? And that's the point of this calculator. And you can see it's a big, right now, to me, that's a pretty big number. It could happen, but it's a pretty big number, especially when we start raising these interest rates. What happens is it also weighs on earnings growth, right? Cost of capital goes up, and borrowing costs go up, or that impacts future cash flows. And I think, like, one more observation, they've been talking about, inflation, and so far we haven't yet seen a reading on inflation that was below 2%, because you would think it would be jumping around a little bit, but we haven't had a reading below 2%. So far they've been raising interest rates and it's kind of coming in, but it's always above that 2%. And a thing to, I think, also pay attention to is that the Federal Reserve, besides raising interest rates, raising lower interest rates, they did something very unusual in the last, like, 10 or maybe even more than 10 years now, maybe 15 years. And that is that they started to actually participate in the free markets by buying assets in huge numbers. And that creates imbalances. And in the beginning, it could feel good, but we don't know yet what the total consequences. And here, I'll show you guys really quick in a chart. Like, this is the Federal Reserve balance sheet. And you could see around 2008, right? When the financial crisis hit, they created this QE easing, right? Where they started buying up treasuries and mortgage-backed securities. But when they did that, they never really stopped, or they never unloaded. They kind of continued.
Jesus.
Right? Look at this trend. They just kind of continued to do it. Let's just keep doing it, keep doing it. They kind of slowed down here, let it run off a little bit. 2020, boom, this hit, and it came up. So what is this? What are we looking at right now? Well, the Treasury, to support the markets and to fight deflation, they went in and started buying government debt, right? They started buying US debt and mortgage-backed securities.
Yeah, well, it just wasn't government. I mean, it just wasn't Treasury
dollars, right? So $8 trillion. But to give you a magnitude of how much they went in, I think something like 20% they bought 20% of the market, 20% of the US debt. Okay, that's and as far as the mortgage-backed securities, I think they bought like 25% of the market. So it's one entity, just goes in there and whoosh, really quickly buys, 20% of the market, 25% of the mortgage-backed securities. And what happens is that people are looking at this chart and saying, well, wait a minute, this now it's being calibrated into everybody's model, saying, well, it doesn't really go down ever. They'll buy, they'll slow down, and every time there's a crisis, they're going to start buying this again and pushing things out of equilibrium. And it's important because, if you buy a bond, that's a little bit different, because if you buy a bond, well, you produce something to earn that money, right? You had to go to work, you produced something, you added something to the economy, and then you took that labor that you exchanged for money and you bought a bond, right, as a storage of wealth. But the Federal Reserve doesn't produce anything, right? They don't make any products, they don't create any services. They just print money and then they buy it, right? And then they give it to the US government, the US government gets it, or the mortgage industry gets it, and then they just spend it. So that's creating this inflation. So it's not just the interest rates alone, but it's this huge balance sheet that they have on there that's extremely inflationary, and we don't know, are they going to let it run off? If they do, that could create deflationary pressures, but so far this is what happens. So this is the breakdown of the Federal Reserve, and we're watching. It's not only looking at their balance sheet, but trying to anticipate what they're going to do, right?
Yeah,
what are they going to do?
And if they're that big of a participant,
how are they going to behave?
What happens if they stop participating?
Here's the breakdown of it, the billion. And we do see that here they own a lot of US treasuries, right? They own a lot of US treasuries. They own a lot of these mortgage-backed securities, right? Wait, over here. Mortgage-backed securities, like 25% of the market, which creates, as you guys know, anybody economics, it just creates imbalances. A lot of times they did try to do that in the Soviet Union, where they were looking at these numbers and trying to manipulate it, but it creates these imbalances, and in the long term, it could break stuff. But what happened was that they started letting this run off, and they said, okay, well, when the bonds mature, when the mortgage-backed mature, we're just not going to reinvest it, and eventually we're out of the market. But remember when the what's that bank, Will, that got into trouble?
Long-term Capital, or just recently the one in San Francisco?
The Silicon Valley Bank.
Yeah, that was it.
Will, I think you're on mute. Or I can't.
I'm not actually. Can you hear me?
Yeah, I don't know. I think there's something wrong with your mic. But in any case, well, what happened was they went in there, right? And they started to create other loans, right, to the banks. So what they're doing is pumping out they're creating new ways of pumping out money, now to the banks. They have, you guys remember this Paycheck Protection Program. Here's the Bank Term Funding Program. And I think that, in the back of people's minds now, what's happening is that things are just staying inflated because they've trained the markets and they've indicated to the markets that they have absolutely no reservations to come in there and start pumping out money at a very fast and furious pace. And I think that that feeds into these inflation expectations that it's going to be difficult to manage. That's why we might be seeing inflated prices in the market and businesses and even in real estate prices. But this plays a big part into it, I believe. So something to watch out. So Will, I'm gonna end it here. I think.
Yeah,
like,
I don't
your-
know.
maybe
Can you
your
hear me
mic
now?
Cut off. So I can't hear you. But
All right.
everyone, thanks for joining. Stay safe out there. Have a good trading day, and hope to see you guys tomorrow.